Assalamualaikum warahmatullahi wabarakatuh. We are from group 1. The case study that we take is Enron. But before we start the presentation, let me introduce the group members. Myself, my name is Rauf, and we have Rafa Alhamdi, and Rizqy Ariel Budiman, and lastly we have Syaira kinanty. Okay, we start from the Enron's background. Enron, established in 1986, was formed through a merger of Houston Natural Gas Company and Internord Incorporated, with Kenneth Lay as its CEO and chair after the Houston Natural Gas merger. Lay swiftly transformed Enron into an energy trader and supplier, leveraging the deregulation of energy markets to enable companies to make future price bets. In 1990, Lay established Enron Finance Corporation and appointed Jeffrey Skilling, impressed by his works as a McKinsey and Company consultant as head. Enron provided global energy and utility services operation divided into major departments. The background of Enron have a long history because it's back on the 1990s, around the year of 19, and Enron is one of the case that from Wall Street, the infamous economy street on America. So that's why one of the study that in Wall Street famous is Enron's. Okay, we're moving on to the Enron's accounting method. Enron's accounting methods were infamously complex and deceptive, ultimately leading to one of the biggest corporate scandals in history. The core of Enron's fraudulent accounting involved several techniques designed to hide debts and inflate profits. One of those methods are special purpose entities. Enron used SPES, also known as special purpose vehicles, to keep debt off its balance sheet. These were separate legal entities created to manage specific projects or assets. Enron transferred assets to this SPES, which allowed the company to move debts off its own books and onto the SPES. However, Enron still guaranteed these debts without disclosing them to investors. This made Enron appear more financially stable and less leveraged than it actually was. We're moving on to the what is MTM method of accounting. MTM measures the fair of value content that can change over time, such as assets and liabilities. MTM aims to provide a realistic appraisal of an institution or company's current financial situation, and it is a legitimate and widely used practice. However, in some cases, the method can be manipulated, since MTM is not based on actual cost but on fair value, which is harder to pin down. This accounting technique reflects the current market value rather than the historical cost. One of the key concepts of MTM accounting is fair value measurement. MTM accounting involves estimating the value of an asset or liability based on current market prices. If there is an active market for the assets, its fair value is determined by the market price. If there isn't, fair value may be estimated using models or other valuation techniques.
And next, I'm going to explain to you about Enron's revenue report versus other big companies. So this report is from 2000, and based on this report, we have a chart that compares between Enron's revenue and other similarly sized companies' revenue. And not only we have revenue, we also have a comparison on employees. So based on this chart, as you can see, is Enron actually has the biggest revenue Enron has more revenue than Microsoft, Dell Computer, Chevron, Texaco, Goldman Sachs, and others. Not only Enron generate the most revenue, Enron also has the least of employees than Microsoft and other companies also. Next is the story downfall of Enron. So, during the 1990s dot-com bubble, the Nasdaq reached 5,000, leading to spike share prices as the new normal. Enron created Enron Online in 1999, an electronic trading website focused on commodities. Enron offered its reputation, credit, and expertise in the energy sector to entice trading partners. In 2000, Enron Broadband Services and Blockbuster partnered to enter the video on demand market, but Enron inflated earnings based on estimated growth. By the mid-2000s, Enron executed nearly 350 billion in trades. When the dot-com bubble burst, Enron built high-speed broadband telecom networks. However, the 2000 recession exposed Enron to volatile markets, resulting in a vanishing market capitalization for many investors and also creditors. So, after I told you a story about how the Enron start to downfall, next is I'm going to explain to you about hiding loss with MTM. So MTM accounting, a technique that measures the value of a security based on its current market value, was used to hide financial losses in trading businesses and operations. Enron used this method to claim projected profit on assets like power plants, even if they didn't yield positive returns. If revenue was less than projected, the asset was transferred to an off-the-books corporation, allowing the loss to go unreported. This allowed Enron to write off unprofitable activities without impacting its bottom line. In 1999, CFO of Enron, Andrew Fastow, developed a plan to show the company's financial health despite many of its subsidiaries' losses. Next is the story of SPVs or special purpose vehicles. So Enron used a complex organizational structure to borrow money without disclosing it as a debt on their balance sheet. Special purpose vehicles or SPVs were used to temporarily shield a primary company by having a sponsoring company process assets. The sponsor company could secure cheaper debt than the primary company, potentially avoiding credit issues. However, Enron faced a primary issue with the lack of transparency surrounding SPVs. The company transferred its stock to the SPV in exchange for a cash or a note receivables, which was then used to hedge an asset against Enron's balance sheet. Once the stock lost its value, it is no longer provided sufficient collateral for SPV use.
The lack of oversight. The Enron scandal involved CFO Andrew Fastow and Arthur Andersen LLP, which is a reputable accounting firm. Despite Enron's poor accounting practices, Arthur Andersen still approved Enron's corporate reports. Analysts questioned Enron's earnings and transparency, leading to Lay's retirement and Skilling's resignation. Enron stocks fell to $39.95, and the company reported its first quarterly loss. Enron changed pension and plan administrators, forbidding employees from selling shares for at least 30 days. The SEC investigated Enron's and the SPVs created by Fastow, and Fastow was fired. Enron had losses of $591 million and $690 million in debt by the end of 2000. Dynegy backed out of a merger deal, and by December 2, 2001, Enron filed for bankruptcy. Conclusion: Enron's bankruptcy and criminal charges. The U.S. Bankruptcy Court approved Enron's plan of reorganization. renaming it to Enron Creditors Recovery. The company's mission was to reorganize and liquidate pre-bankruptcy operations and assets for creditors' benefit. Enron paid over $21.8 billion from 2004 to 2012, with its last payout in 2011. The criminal charges. First, Arthur Andersen LLP was found guilty of obstructing justice in 2002 for shredding Enron's financial documents. Then the conviction was overturned, but the firm was deeply disgraced and dwindled into a holding company. Second, Enron's founder, Kenneth Lay, was convicted on 6 counts of fraud and conspiracy and 4 counts of bank fraud. Third, former CFO Andrew Fastow pleaded guilty to wire fraud and securities fraud, served over 5 years in prison, and was released in 2011. And fourth, former CEO Jeffrey Skilling received the harshest sentence, convicted of conspiracy, fraud, and insider trading in 2006. He was released on February 22, 2019. Due to the Enron accounting fraud, regulations appear after Enron. The Enron scandal led to new regulations and legislation promoting financial reporting accuracy for publicly held companies. In 2002, President George W. Bush signed the Sarbanes-Oxley Act, enhancing penalties for destroying, altering, or fabricating financial statements and defrauding shareholders. The scandal also resulted in increased ethical conduct by the Financial Accounting Standard Board, or FASB, and increased independence of company boards of directors. These measures aim to identify and close loopholes by the companies to avoid accountability. This video was based from the article Enron Scandal and Accounting Fraud: What Happened by Troy Segal via Investopedia. That's all from our group. Thank you for your time, and we'll see you guys in the next one.